Hello, everybody. My name is Malcolm Penn, and I'm the founder and CEO of Future Horizons, one of the world's leading semiconductor industry experts. What I would like to talk to you about today is what we see as the new trend in supply and demand in the global semiconductor industry. I founded Future Horizons just over 33 years ago to provide industry analysis and an impartial, independent voice on the industry trends. We are staffed by industry veterans with almost 300 years of collective industry experience, with my career now spanning 6 decades, coincident with the very first integrated circuit, so our knowledge and experience both predates and exceeds that of most still working industry executives and analysts. With this as our background, we have been chalked up an especially good track record of accuracy in our forecasts and have proven to be especially good at spotting trends well before anybody else has seen these coming. Right now, the industry is facing a wide range of serious economic and political challenges. The world is still suffering from supply chain disruptions and shortages, especially in components, together with the economic disruption caused by the war in Ukraine, energy, food and commodity price inflation, the still ongoing impact of COVID-19, and for the first time in a decade, a real risk of a global economic slowdown and even a recession. The 2021 shortage was a perfect storm that has been brewing actually since 2016. It was driven by a paradigm shift in board level priorities, which in turn was driven by a sluggish global economic recovery ever since the Lehman Brothers crash, which was depressing industry growth, leading people to believe that the glory days were over and we were now condemned to low single-digit industry growth. This in turn fueled the drive for balance sheet efficiency and asset-light zero inventory mantra, which in turn increased outsourcing and further consolidation in the industry, resulting in better foundry efficiency, lower production costs, but with fewer supply options now available. What could possibly go wrong? This model was working really well, but there was no slack in the system. And everybody forgot that there was a 12-month delay from CAPEX spending to a corresponding increase in capacity. And they also forgot about the 4 months or so production lead time, plus the scheduling time. So there's a 6 months delay from ordering the parts to you getting the ones you want. All the signs were there, but no one was paying attention. Everybody forgot a small uptick quickly upends the status quo. The perfect storm broke in the third quarter of 2020, but nobody was paying attention at that time. They were still dwelling on the impact of COVID 1 quarter earlier. The rebound was sharp and rapid 1 quarter later, and we had almost 10% growth in the semiconductor industry in that corner, much higher than you would normally expect, which fed through into the fourth quarter, which triggered the whole industry into a severe undercapacity situation. The widespread disregard for the supply-demand fragility was pretty well there and established. It was nothing you could do about it at that time. But COVID was the trigger, not the cause of the shortage. The industry fundamentals hadn't changed. They were just ignored. The industry was still fundamentally cyclical, and we had this long disparity between the ability to provide supply and the demand, which can change very quickly. The supply maxed out in the fourth quarter of 2020, which was due to a lack of investment in the fourth quarter of 2019. So that was a full 6 months before COVID hit the world. So you can't blame COVID on that. COVID was just the trigger which caused demand to surge, which tipped the industry into an undersupply situation. The real cause was the industry-wide focus on profits versus security of supply. The boom was both predictable and actually nothing special. A lot of talk in the industry about this being unprecedented. Well, it wasn't. There have been 15 previous upturns since the first cyclical downturn in 1961, 10 of which were much stronger than the boom we experienced in 2021. The shortages would, in fact, have hit home in 2018 had the market not collapsed, driven by the US-China trade wars and tariffs, which killed the demand in the second half of 2018. The problem was the industry had not had a shortage since the 2000 dot-com boom. So a lot of people in the industry had never experienced this. They didn't know the signs, they didn't know what to look for, and it came as a shock when this industry boom took off. And everybody was complacent. It was different this time. The industry was bigger, it was wider spread, it was much more broad. A slowdown in one market would be offset by an increase in the other. It wasn't, because it's more driven by economic fundamentals, supply and demand imbalance, rather than simply the growth of new markets evening out the collapse in more mature ones. When you look at the four key driving influences in the market, and the real four factors that we look at all the time are the economy, the unit demand, capacity, and average selling prices, ASPs. The economy determines what users can afford to buy. The stronger the economy, the stronger the demand. The unit demand reflects what users actually buy, but it's not quite that simple, because you have to include in there an adjustment for inventory. And once lead times start to extend, they have to increase their inventory to cover the now longer delay between them ordering parts and receiving the parts. So inventories tend to rise quite rapidly in a market boom, and they likewise get liquidated when the lead times start to shrink as companies liquidate their now bloated inventories to get them back to a normal status quo. The capacity determines how much demand can be met. And average selling prices sets the price the units can be sold for. And this is typically a supply and demand factor based on cost rather than a value proposition. It's very difficult for the industry to sell on value because it is a cost plus driven industry. And so it really does depend upon the cost of the parts you're making rather than the value that they provide to the system manufacturer. We believe you need to keep track of the current status of these four factors versus their underlying trends. And that's important, because if they are starting to deviate from the underlying trend, if the data drifts above or below the trend line, then we believe a correction is inevitable. And it's rarely different this time. Very rarely is there a fundamental paradigm shift in that trend. And so those trends are really something that you can set your clock by. What is the current status of these influences? Well, the economy is in pretty bad shape everywhere around the world. We're experiencing a toxic mix of slowing demand and fears of recession. There are numerous supply chain disruptions. There's faster monetary normalization after the period we've been experienced. There is global indebtedness everywhere, both in everywhere you look, whether it's household or corporate or government. Indebtedness is at its highest level ever. The Russian sanctions due to the war are having an impact both ways, not only on Russia, but repercussions in the Western world as well. So we're seeing lots of disruptions there, lots of real storm clouds on the horizon, with no real good news to offset those negative factors. The unit demand is running well above the long-term average. We're currently shipping about 8 billion units per month. The trend line indicates that that should be much closer to 6.5 billion units per month. So the shipments are seriously overinflated by at least 30%. Overall lead times have extended dramatically. They've gone from a typical 4 to 6 weeks to 50 weeks and higher in some cases. And that's caused high levels of inventory throughout the production food chain, both at the semiconductor suppliers and at the OEM customers as well. We've experienced a massive expansion in capital expenditure, which will reflect itself in new capacity, but not until a year after the CAPEX spend has incurred. We saw this starting at the beginnings in the second half of 2020, but at a very low level. But in 2021, it increased dramatically and was up 44.5% on the previous year, representing about 18.5% of semiconductor sales, which is significantly higher than that long-term trend, which typically runs much closer to 12%. So we're running 50% much higher than we really need to have. The increased capacity is starting to bite home in the second half of this year, targeting an overinflated demand, because we're running for that 8 billion number level, not the $6.5 billion level. So we've got this capacity chasing an artificial number, and it won't really start to impact until the second half of this year. Average selling prices have been on a steep upward trajectory since the end of last year. and they're growing now about 35% above the trend line. So again, as with the unit demand here, we're seeing the average selling prices much higher than they are above their trend line here. Now, the interesting thing to note is that Gordon Moore actually had a second law. We're all very familiar with his first law, which was talking about the ability to increase complexity, but he actually had a second law, which stated that the average IC ASP trend was $1. Now, nobody particularly liked that law, so it never caught on. His first law did, but the second law was pushed into the sidelines. But in fact, the data that we have been plotting shows that that second law is just as accurate as his first law is. So we've got a situation now where we're coming towards 2023, where all four of the influences are showing serious storm clouds on the horizon. We believe the industry is facing a potential 1-2 knockout blow. We expect to see in the second half of this year a capacity boom due to the CAPEX spend that we've been experiencing, coincident with a slowdown in demand driven by the softening global economy. And if that happens, that would be a real severe blow to the industry growth. Our forecast for 2022 is for 6% growth. That's coming off the 26% growth that we saw last year. That's not normal to have a slower growth in the second half year following a double-digit growth number there, because you're coming off a higher number. We originally thought that the industry would be about 10% growth this year, and 10% is still possible, but we've lowered it to 6% just recently because what we see the overheating market, but also because of the economic downturn. With the issues that we weren't facing back in January when we made our original forecast, the war in Ukraine hadn't really hit as bad as it is now, and we hadn't seen the inflation aspects which were causing the economy to slow down, depressing consumer demand, which in turn will depress the demand on the factories. We expect to see the supply and demand rebalance once the 2021 CAPEX increases start to bite home, and we expect to see that in the second half of this year. The slowdown in demand, we don't see that going away anytime in the near term because these inflation factors are now really gaining some traction there. So the world is going to have to fight that inflation dragon, and the only way to fight inflation that the economists know is to increase interest rates, which in turn depresses demand. So the very medicine that you're taking is actually going to make the matters worse from a semiconductor demand point of view. And the economic slowdown that we're experiencing, we really don't see that changing any near in the next 12 months. So what does that mean for the outlook for 2023? Well, let's look at just some of those factors there. The unit demand. Here you can see the monthly unit shipment growth, and you can see that trend line there running well above that dotted line trend. The current shipment rate is running significantly higher. We believe that that's going to have to reverse. That current shipment rate is going to have to reverse. So at some point in time, you're going to see the shipments drop dramatically below that trend line to get back onto the long-term average. And typically when that happens, the unit demand drops by anywhere from 50 to 60%. The shipments are overinflated because we're now shipping against the real demand plus a lead time and inventory adjustment. And once that lead time shrinks, the inventory will get liquidated, customers will push out their orders, and the backlogs on semiconductor companies will disappear overnight. Likewise, the CAPEX, we can see here, surrounded in that dotted red line there, the current rate of spend on capital equipment, and it's well above the trend lines there. The trend line is around 10%, but it spans between 8 and 12% of sales. So we're way above that at 16.5%. We had been experiencing a sustained period of underinvestment, which is what caused the shortages to bite home in 2021. They would have bitten home in 2018 had we not had the market slow down, which offset the impact of the potential capacity shortage. So that capacity spurt there, that CAPEX spurt there, will actually start to bite home in the back half of this year and have a real bad impact throughout the whole of 2023. The ASP recovery, you can see here, those two red lines going sharply vertical, has been in full flow since July 2021. Once the demand slows down, ASPs will fall on the basis that any order is a good order. And what we have to remember is you've got to enjoy this ASP surge while it lasts, because the long-term ASP growth is actually zero. When you look at that right-hand chart there, you see that the curve is equal amounts above that trend line as below the trend line, and the long-term average ASP growth is actually zero. The collapse, when it does come, will be sharp and sudden. And you can see here those negative plummets going down there. It literally is falling off a cliff, because once the unit demand slows, the only way chip companies know to try to increase orders is to artificially stimulate demand by dropping the price. And already we've seen news from Intel, for example, where they have already dropped the price of some of their microprocessor products to offset a slowing down in demand they see for PC and server microprocessors that's already happening in the fourth quarter of this year. So it's already happening, and that will continue as that spreads throughout the industry. We believe the market will likely go negative in 2023, and our forecast is for minus 22% negative growth. Now, that may sound bad news, or it is bad news. It may sound a big number and a very pessimistic number, but in fact, when you look at the past historical trends, it actually isn't that severe. There have been many other correction years where the growth has gone down, even as high as minus 38%. The exact magnitude of the number will really depend on the timing of events. When will that kick in? When will supply come into supply and demand? We believe it will happen in the fourth quarter, but if it's delayed a little bit, the market will be slightly worse in 2022. If it comes sooner, the market will be slightly less than that 22% negative magnitude. Soft landings are unrealistic. People always say this time it will be a soft landing and so on. It's never happened yet in the 60-year history of the industry, and I really doubt it will happen this time as well. When the bubble bursts, it bursts. Units plunge first, and then the ASPs collapse pretty soon thereafter. So our message is simply, how do you cope with this? Well, our message is be smart, be prepared. It really is never different this time. So don't plan for it to be different this time. Plan for it to follow the trends that the industry has been following for the last 60 or so years since its very beginnings. The Polish philosopher Rosa Luxemburg, she said, before a revolution happens, it is perceived as being impossible. But after it happens, it's seen as having been inevitable. People are always wise after the event. Well, my message to you today is, for revolution, simply transmute that into chip market collapse. When the industry does collapse and goes into the downturn, which we believe will be in the second half of this year, you will be amazed by the number of people that say, well, of course, we knew this was going to happen all the way along. It always does. It always has. It was inevitable. Our warning to you is that, yes, it is inevitable, so be prepared for it now. Now, we are pretty much alone in the industry for forecasting this. When we make this forecast in January, we were absolutely alone. But slowly, people are starting to come around to our way of thinking that the downturn is inevitable. It is coming, but no one is really quite as insightful into what we believe the impact of that will be as we are yet. But we expect to see others coming on board within the next 3 to 6 months. Our basic message, the first rule is keep track of those industry fundamentals. They are measurable. There is good data out there to enable you to keep track of those data there. And it helps you put the froth and the noise that comes from the data into perspective. The second rule is, when you're in a market boom, as we currently are, come to work every day planning for it to end tomorrow. You need to have your survival plan already prepared in your back pocket, ready to dust off and pull down and enact immediately. The sooner you act, the less the pain will be. If you delay, hoping the market will go away, hoping the crash is just a bit, it isn't. Once it happens, it will tip over. So whichever part of the cycle you're in, always have the plan ready to bring out, to enact for the market to change tomorrow. So thank you very much. It's my pleasure talking to you today. If you have any questions, please do email me your questions, and I'll be very happy to address them. And if you'd like a copy of the presentation, again, please email me, and I'll be happy to provide that for you. So thank you very much, and enjoy the rest of the conference.